What's going on, everybody? Today we're going to talk about the infinite banking concept. We're going to talk about a thing that we call BYOB, be your own bank. And this whole process is very simple. It involves changing one thing and adding one step to your life. And what you're going to get from this is you're going to get to take back the banking functions in your life. But in today's episode, we're going to go deep into real estate. And we're going to cover two topics in real estate, two that are very near and dear to me. Number one, how are you buying your real estate? My guess is the same way I used to. You would borrow money from someone else's bank. Whether it was a private lender, a hard money lender, or just a traditional bank, you'd borrow money from them to do your real estate deals, and then you'd make monthly payments back to them and eventually pay the principal off when you sold it. But today we're going to change one thing, and that is who's the bank? And then we're going to cover private lending, because the ultimate in real estate, make no two ways about it, is being the bank. It has always been the ultimate when it comes to real estate. So let's dive into how you are going to be your own bank. So I thought the best way to show you this is just to visually give you the numbers and show you the flow of how the infinite banking concepts can be used with real estate. And what I've done is created a whole walkthrough. Remember that circle you always hear me talking about of how your money flows? So if you're ready, so am I. Let's do this. All right, so let's dive in to some real estate, but let's do it a little differently. First thing I want to do is I want to kind of show you the different ways that you can do real estate. I created a whole slideshow just to show you the flow of the numbers, but the traditional ways you would buy a rental portfolio would be, number one, you'd have to identify the property. After you identify the property, do the cash flow analysis and everything you'd want to do to make sure that that property is right for you, you'd need money, right? Isn't that the magic? You gotta have the money to get the real estate. So you'd probably look to go to a bank. A bank's gonna require you to put 20 to 25% down, plus you're gonna have to make monthly payments to them for the next 20 to 30 years. The other option is, well, if you had cash, you could just pay cash for the property. But now, whatever the property costs, let's call it 350 grand, that $350,000 can't work for you ever again. If you didn't have the cash, what you could also do is you could then go to a hard money lender. You'd have to bring in some money of your own, and then you'd borrow money at a higher interest rate from an institutional hard money lender. And the ultimate, you might be able to go out there and find yourself some private lenders, which the second part of today's training, I'm going to show you what it would look like from being a private lender and being the bank for this real estate deal. But those are your options. You have to find money from somewhere. But let's just use example number two. You got the cash. Let's just say you've been saving up, you had a windfall, you had an inheritance, you just got the money, and you want to buy some real estate because you know your money needs to work for you and you need to make a return on it, and real estate's your choice. So you want to deploy some capital. Well, let's look at what that might look like if you change one thing, and that is where your money goes first. Let's just assume you had $1 million and you were going to save money every single year after that because you had the means. Now, I know that's not for everybody. Some people would be less, but I want to use $1 million. You got it in an inheritance, and you're going to buy some real estate. And you came to us and you said, hey, how can we design our own banking system? And that's what we're going to do. We're going to design a banking system. Now, that banking system is not going to be held at a bank. That's it. It's going to be held at a giant mutually owned life insurance company. We're going to design a whole life policy that is going to be where your money is going to go, so that it doesn't sit in someone else's bank, it's going to sit in this specially designed policy. And I'm going to give you some of the reasons why that would make sense. So if you look over here at the board, let's just say we had $1 million and we wanted to dump in $900,000 right up front. And then what we were going to do is we were going to fund it at $8,333 a month. That works out to be $100,000 per year. So you got 900 going in, 100,000 going in every single year thereafter. So we would design that policy for the maximum efficiency because we want your money to grow. We want to put the lowest death benefit on the policy, and we want the highest cash value so we can go buy a whole bunch of real estate. But the reason why we would do that, I'll show you in just a second. But we have to design it. which is a tricky art. The way we're gonna do this one is we're gonna do 50% to paid up additions, and we're gonna do 50% to base. Now I know a lot of you are like, why would you do 50-50? You should do 90% to paid up additions. But what you don't understand is a policy design like this, you wouldn't be able to. The MEC rules, the IRS rules would stand in your way. So when we designed this, we designed it the most efficient way, and guess what? That was it. But it required a term rider, term insurance, to satisfy the MEC rules. So the reason why we're doing 50-50 is because we need a giant term rider on here to support this thing. Now some of you are thinking, what does all this matter? Well, let's just skip right to it, and let me just show you the numbers. This is what matters. So here's how it's gonna look. Year number one, we're gonna put $1 million. We're gonna change the $1 million from the bank that you had it in over into your own bank, which is this specially designed whole life. And the reason we would do that is for future growth. So the first year, we're gonna have access to $917,570. That's 91.76% of every dollar you put in. Now for some of you, you're thinking, why would I ever do that? If I put it in the bank, I have 100% of that money. Well, yeah, but in a bank, if we put $1 million in the bank, even if it paid the same rate that this insurance policy does, which this particular policy pays 5.65% dividend crediting rate. So you'd need to find a bank that pays something similar to that. But even if you did, when you put the $1 million in, if you found a property for $917,000, even let's just say we took out $900,000 to go buy a property, how much money would be left in your bank? $100,000, right? The $1 million you put in minus the $900 you took out to buy real estate. You would have $100,000 left. But you see, when you do it in a policy, we don't have $100,000 left. We still have the full $917,570, even though we took $900,000 out. The reason for that is the life insurance company lends you the money from their general account. And what they do is they give you this loan, and they don't even care if you pay the loan back, because they're going to subtract $900,000 from this $13,525,470 death benefit. So therefore, if you die the next day, your beneficiaries will get $900,000 less, because the insurance company advanced you part of your death benefit while you're living. But because they did that, your cash value, this 917, acts just as collateral for that loan the insurance company gave you against the death benefit. Therefore, all $917,000 is still earning the interest and dividends, the dividend crediting rate, even while you got to deploy the capital. But let's get into some of the numbers. If this is what we're gonna do, how do the numbers look? Well, the first year they look terrible, right? You put 100 or $1 million in and you only took 917. So that literally means it costs you $82,432. Who would do that, right? Well, the person that would do that is the person that understands mathematics, because the next year they put $100,000 in, and that $100,000 is worth $107,219. That's 107.22% cash on cash return of what you put in. That means you literally made $7,219, 7.22% on the $100,000. Now, because of the way we're going to use this, we're going to put money into the policy, and we're immediately going to deploy that money out there to buy real estate, okay? That's all we're going to do. So if I just go up here and I just tell you, all we're going to do is we're going to deploy every dollar we can into real estate. So each year you put money in, we're going to take a loan from the policy every year, and we're going to just continue to keep buying real estate. But each year you put money in, you have more money to take out. Third year, you put 100,000 in, you can take out 113. That is a 13.26% cash on cash return. Now, some of you do math a little differently than we do here when we're talking about the infinite banking concept. So let me address this for all of you. Some of you are looking at this saying, I put $1 million in, then I put 100, then I put 100 in. So I got $1.2 million in. And I don't have $1.2 million in cash value until the fourth year, which means your cumulative break even in this policy is year 4, which means year 4, I put in 1.3 million, and in year 5, I've got 1.385. So between year 4 and 5 is where you break even, and you can see that right over here, projected premium to cash. So it took you 4 years to get all your money back. That sucks, right? It would only suck if you didn't have access to the money. But you see, we have access. We were able to take this cash value out every single year and use it to acquire an asset. And in this case, we're talking about real estate. We're talking about apartment buildings. And every single year, we're gonna literally take the money that the real estate earns and we're gonna roll it right back into the policy. And I'm gonna show that in just a second. But I just want you to understand why we use specially designed whole life to do this. And we use it because we understand over time, the whole life is gonna pay us a heck of a lot more than we could get anywhere else. Plus, well, if you've got a family, the death benefit sure is important because if you die too soon, your family's gonna be taken care of to the tune of tens of millions of dollars. But let's dive into how this whole thing works. Oh, hey folks, make sure you take a second and flip yourself into this little unsubscribe button. And also while you're at it, there's a little bell, smash that bell. Not bad. So you're notified every time I put new content out. See you then. So let's just go year by year, and I'm just gonna walk you through the flow. And all I want you to think about is the flow of this is a circle. We want our money to start here, and we want our money to end over here, the asset. And in this case, we're gonna buy apartment buildings. But every year, the apartment buildings are gonna make a return. You're gonna have money coming in from the apartment buildings, and we're gonna take that money from the apartment buildings, we're gonna put it back in your bank. Because why would you put it in their bank if you've created a banking system? You're gonna put it back into the policy, and every time you put it back in the policy, you have access to it again, okay? So we're just gonna draw a circle, but let's walk through the numbers here. First, we're gonna put $900,000 in as a dump in. Then we're gonna put $100,000 as premium deposits. So we got $1 million going in, and we're immediately gonna take a loan to buy a property for $356,000. And I'll show you at the end what this property looked like from an analysis standpoint. $356,000. So what we're gonna do is we're immediately gonna take the $356,000 out in the first 30 days. So this is roughly a 30-day period from the time when we deposited the money to when we're gonna take it out. And could we take more? Yeah, I already showed you. You could take up to 917, but we identified a property for $356,000, and this is the first one we're gonna buy. So we take the $356,000 out, we buy the piece of property. So this rental property is gonna make money in the tune of $38,294 a year. Now at this point, most people would have to make a decision. Where's that $38,000 gonna go? Prior to you learning this, that $38,000 went back to a regular bank account. But we're not gonna do that. We're gonna take that $38,000, we're gonna put it in our private banking system, that specially designed whole life. But we have to clear through what we call a segregated bank account. And this is just a bank account we set up to do books and records. So I'm just gonna write that. The only reason we have this segregated bank account, which is just another checking account, is books and records. We always wanna keep track of how much did we take out in loans and how much money are we putting back into our banking system. In this case, we're gonna have $38,000 run through here. We're gonna put $38,294, exactly the gains. We're gonna take the gains and we're gonna put them back in the policy. But when we do that, we're gonna put them back as loan repayments. And let me show you why. When we come over here and you look at these numbers on this side of the screen, we put $1 million in. We took out a loan for $356,000 from the policy, which was the insurance company advancing part of your death benefit. The insurance company is going to charge you interest on this loan at a rate of roughly about 5%. Depending on the policy you have, it could be a little less, could be a little bit more. We're just going to use 5% simple interest. That means $17,800 of the $38,294 is going to go to the insurance company for loan interest, represented right there. But it brings your loan balance from $356,000 down to now $335,000, which means you're only paying 5% on $335,506. Now let me ask all of you a question. How much of your money is earning interest and dividends? The full amount. You remember from the prior slide, $917,000, even though we took $356,000 out. So if over here, you're earning roughly $565 gross dividend crediting rate, and you're paying 5%, aren't you making a spread? And remember the returns I gave you after the second year? Cash on cash, you're making a spread, and after fourth year, cumulatively, you're making a spread. But if you just do the raw math, there it is. but your rental property is also producing gains. So on the same dollar, you made a spread here and you made money over here in the asset. That's why we do this. So what we're gonna do is now we're gonna look at year 3, year 4, and we're gonna go to year 15. I just wanna give you a snapshot of what this looks like, because you all remember that illustration that I showed you. Your numbers, your cash value is gonna grow every single year because of uninterrupted compounding interest. But now we're gonna look at the effect of the rental income playing into the infinite banking concepts. So as we go to year 3, we're gonna do the same thing. No dump in, but we still put $100,000 into the policy. Then what we're gonna do is we're gonna take $313,000, which is the current loan balance, and we're not gonna take any loans out. All we're gonna do is we're gonna let the compounding continue because we already own the property, so there's no new investment capital, but we're still making $38,294, and we still have to put that money back into the policy. And every time you put that money back in, even though it's a loan repayment, the money's fully available. So all $38,294 becomes available. At the end of the year, here's the numbers. We've injected $1.206. We've taken cumulative loan payments, which is this gains, of $114,882, of which we have given back to the insurance company $50,275, making the loan balance now $291,000. So now remember that loan we took, which they charged 5%, we're only paying 5% on $291,393, while all of your money, all of it, has continued to grow uninterrupted. I'm just trying to drive this home. Your remaining cash value is $846,662. Just look at the math. Your remaining cash value, you could go buy 1 property, 2 properties, 3 properties, whatever you could buy with $846,000, and you'd still be making interest and dividends on all of it. That's the advantage of doing this. And let's just go one more year and I'll show you that. So the 4th year, no dump in, we put another $100,000 in. Our loan balance is now $318,000, but now we're gonna put a roof on. We're gonna take $26,700 out, do a roof. Books and records are gonna show that $26,000 loan, and we're gonna put the roof on the property. So there we go. We got a roof that we just put on our rental property. Nothing changed from the gain standpoint. We didn't increase rents. I'm staying static with rents. So you made $38,294, and again, you put $38,294 in your policy as loan repayments. So you've injected $1.3 million. You've made loan payments back to your policy, to your banking system. Now remember, loan payments when you are the bank is money you get to use the next day. Loan payments when you pay somebody else's bank, like a mortgage, you never get that money back. It's their money, not your money. You're changing where the money goes and who controls it. Every dollar that you've put back into your policy has been money you could use the next day minus the interest cost, which is right here. So cumulative loan payments, we've made $153. The loan interest we made was $66,179. And then your loan balance is $295, getting charged 5%. So also what you're doing is you're not losing liquidity of your money, but you're still earning on all of your money. Not only that, every time you put money back in the banking system as a loan repayment, you're reducing the loan, which means you're paying less to the insurance company, which means you're making more money. It's math. That's all it is. Your cash value is now $961,992. Okay, so now what I'm going to do is I'm going to fast forward here to year 15. I want to show you the impact, because investing in real estate is a long-term investment, and just like being your own bank, that is a long-term, it's not an investment, it's a long-term strategy. Becoming wealthy is a marathon. It is not a sprint. So don't try to sprint your way to wealth, because if you do it the right way, the way I'm showing it, you'll never give the money back, which makes you wealthy longer. Here we go. This year, year 15, we're no longer gonna make $100,000 premium deposits. So we're no longer saving $100, we're only saving $50,120. And the reason for that is we are efficient now. The policy has evolved. It is growing a lot. And I'm gonna go back to the numbers in a second. But here we go. We're gonna run everything the same. You still have that same property making the same gains. Unlikely, you'd probably be making more because your rents would have went up, but that's okay. We're gonna do the same thing. $38,294 goes into here, but now see, we're not gonna make any loan repayments. The money's just gonna stay here. Why? The loan is paid off. 15 years into this, you have repaid the loan, and here's the numbers. You've injected 2.1 million, a little bit over. You've made loan repayments of 536,116. The cumulative loan interest you paid was 153,428. You would have paid a traditional bank significantly more because number one, the interest rate would have been higher. Number two, you wouldn't have been controlling the flow of money. And number three, you didn't lose any liquidity like you would have with the regular bank. You owe nothing to the policy, which means your cash value is $2.888479. $2,888,479. And you got a fully bought and paid for rental property in your portfolio. So here's how this would have probably shaped out. Your house more than likely would have appreciated. We started at a $350,000 rental. We're going to assume a 4% appreciation per year, and we're going to assume that it appreciates over 15 years, which means your house, your rental, is now worth $641,135,000. Had you gave that money up to the bank, you would have paid the bank $391,907 in interest. This is traditional bank financing at a rate of only 5.75. I went with the lowest rate I possibly could find. And you still gave up $391,907. The total cost of the loan was $747,907. You're underwater. You paid more for the property with interest than what it's actually worth in this scenario, because you weren't in control of the money if you used traditional bank financing. But remember, we didn't do that. We used our own banking. And here was the math shape up. Rental income, $3,191. Mortgage payment, $2,078. Monthly rental income, right here. That's your mortgage payment, $1,113,000. In 15 years, the total loan would have cost $373,953 by the end of the 15th year. The total principal paid is only $105,820. Remember, at 15 years, with our bank, the loan was paid back. You owed nothing to the insurance company. You had all that cash value, over $2 million. Here, traditional bank financing, you've only paid $105,000 in some change back to the bank. The total interest paid was more than what you got back in principal. You paid $268,133 in interest. And that's by the end of the 15th year. The $1,113 of rental income has accumulated to $200,340, and the remaining loan balance you owe is still $250,179. You are still upside down. This is how most people buy rental properties, and they don't see a problem because they don't know the other side. The other side is what I just showed you. And again, here's the prepayments. It's as if you repaid the whole thing in 15 years. Let's just say you took the extra money and you repaid the loan, and you tried doing it in 15 years. Doesn't matter, the loan still cost you $510,000. Principal was $356, but the interest you paid was $154. You would have still been better off doing this with your own banking system. And then we did a summary just showing you IBC was the way to go, because IBC, your loan payments were $536,116. Interest paid about the same as repaying your loan in the 15-year mortgage at $153 versus $154. So you're still better paying the insurance company versus paying the bank. But here's why you're even way better. If you just paid the bank, even though the amount of interest you paid and the amount of loan payments you paid are very similar to IBC versus the bank, your bank has $2.8 million. Their bank, if you use the traditional bank financing, has nothing. I think all of you would prefer $2.8 million. Not only that, you put in $2.1 million into the policy, but you got 2.8. See how beneficial this is? And you've got a death benefit of $4,953,067. IBC had a $26,700 loan at the end of year 4 that has not been accounted for into this. So you actually have more money than that. Net benefit. So we just ran a net benefit at the end. Right here, the death benefit 4.9, no death benefit other ways. You lost $49,000 if you did a 30-year mortgage, and your net benefit would be 0 in the 15-year, and your net benefit is $286,792 if you did it with your own banking system. Available cash, available in. The difference is the difference between cash put in and cash value you have. Which way do you want to buy properties, folks? Because I think this way, if you have the capital, is the only way you should ever consider. So now let's flip the script. Let's just say you got a little bit of money and you're deciding, should I buy real estate or should I just be the bank and lend? Well, let's look at the same scenario. The first example, I showed you how to buy a rental property. And I showed you having a bunch of money that was just sitting in a bank that you could have paid cash for. But now what we're going to do is we're going to become the bank. But I've already walked you through what we're going to do. We're going to change where the money goes first. Because now you're just going to lend. Let's say you find a deal on privatemoneyclub.com and you want to lend on it. So in this scenario, minus the fly, we have $100,000 that we're going to put in one time. Oh, you're wondering what the fly is? A second ago, we had a fly land on the screen and start drawing lines all over it. So we just shooed the fly away, shoo fly, shoo. And now we got 100 grand in money that we're going to deposit into the policy. We're also going to deposit $12,000 every single year in premium deposits. That's our future savings. The design we're going to do, we're not going to talk too much about that, but this is also a 50-50 blend. The reason we're doing a 50-50 blend is it is the most efficient design we can do. Here's the proof of that. Here's the numbers again. Year one, we had put 112,000 in. The green is guaranteed, the other is non-guaranteed. The difference between guaranteed and non-guaranteed is this column here, dividends. But just look at it. You put 112 in, and we have 103,000, 92.3%. It's about as efficient as it gets. Along with that, we got a $1.8 million death benefit. Year two, you put 12,000 in, and how much can you take out? 13,323. How many of you want a bank account that you can put $12,000 in, and at the end of the year, you can take 13,323 out? And the next year, you'd put more money in, wouldn't you? The next year, if you saw what it did the first year, you'd put another 12 grand in. And then that year you could take 14 out, and then 14.9, then 15, then 16. Am I driving this home? This is why we use specially designed whole life. The returns that we receive because of uninterrupted compounding interest cannot be beat anywhere else. And then to boot, we can then take that money out. So let's just say we took 100,000 out and we lent it through PMC on this piece of real estate. We'd still be making interest and dividends on the full 103,375, even though we took 100 out, because all they did is they gave you 100,000 of your death benefit to use while you're living. So let's go through real quickly, seeing as though now you know how the flow works, and let's look at the numbers. This is a lending deal, and remember, we're just gonna go round and round the circle, but this is a little bit easier. So first thing, we deposited 100,000 all up front, one-time dumping. And then we put 12,000 in each year. We're going to take the loan of $93,308, and we're going to basically lend that on Private Money Club. And we're going to lend that on a deal, and you can see it kind of down here at 12% with a 5% policy loan interest. So the insurance company is charging you 5% on the 93. We are over here earning 12% on the 93. So you're already making a spread there. But now what we're going to do is we're going to take the interest earned that year, which is $11,165, and we're going to take that, and over here, we're going to give the insurance company just the interest charged on the 93, which is $4,652. We're going to leave the $6,513 in the segregated bank account, and we're going to add it to the next year, okay? So the next year, we're going to just start over, but here's your injected amount, 112, year one. You had 109,888 available. You had a death benefit of 1.7 because we subtracted the loan from the death benefit. You lost money, but you only lost 1.89%. That was the net loss. So year one was a loss. Well, let's go to year two. We're doing the same thing. We deposit $12,000 in a savings into our policy. We immediately have $105,028. We're going to take the full amount, $11,991, and we're going to lend it, but we're going to add it to the net gains that we had year one, which was $6,513, which means we can lend another $18,504. So we find another deal on Private Money Club. We lend all of it. The $111,541 is the cumulative amount lent, which is the year one lent and the year two. These are two separate deals. Again, 12% interest. Take the gains of $13,385, do the same thing. $5,251 goes to the insurance company in interest. We keep the net, $8,133. We put in $124. We have $131,334 net benefit. Death benefit of 1.7. Our cumulative return this year was 5.92%. Let's go to year three. And I'm going to go fast because you all know it. Loan balance, 117. We have 8,133 in the segregated account, net from the prior deal. We're going to make another loan for 12,686. Remember, we put 12 in, We take 12,686 out. We're earning interest and dividends on the full amount, uninterrupted. 20,000 is the amount we're able to invest again in year 3, which is going to make us 15,883 because we now have 132,000 lent out. Give the insurance company their cut, 5,886. Keep 9,998. Cumulative, we put in 136. We have 155. Death benefit of 1.7. Our cumulative return is 14.29. You see now, in 3 years, no matter how you shape this, we're making 14 when everybody else is only making 12. This is where uninterrupted compounding interest really starts to matter. Let's just jump up to year 10. We deposit only 10,803, not 12,000. We have 230.46, and we lend out an additional 18,000. So we put in 10,803. We have the ability to take 18,477 out. Imagine that. Put in 10, take 18,000 out. Not bad. But our net gain the year prior, year 9, we had $28,460 available after paying the interest to the insurance company. We're never paying principal back to the insurance company. So now we lend another $46,937. That's the interest, the net interest, plus the amount of the new loan. We now have $372,000, $254,000 lent out, which is now producing an income of $44,670 a year. We're going to give the insurance company $11,502 of that. We have 33 net. Here's your numbers. You put in 216,409. You have 430,983. Your remaining death benefit dropped because we got rid of the term insurance in the 8th year. But if you died, you have 386,687 plus the loans. Your cumulative return, cumulative, not cash on cash, is 99.15%. Everybody else is making 12%. Do you see the advantage of using the policy? This is called the gains projector. This is how we run the math. It's a proprietary system that allows us to run year over year so we can see what your net return is. So folks, I know this is like a wall of numbers, but really the only number that matters is this one down here at the very bottom. What was your cumulative return? How much money did you make, and what was the economic benefit for you and your family by changing one thing and adding one step? So folks, I think you all can see why we use the policy as our holding tank for our capital, why we use the policy as the start for where our money begins and where our money ends. This is private banking. We're not the only ones doing this. This has been used by the wealthiest families in history. It's time for you to start learning. But there is still one more thing that's very important to you taking back control of your wealth. I'll show you. So in this video, we talked about how you flipping where your money goes first will help you become your own bank, and that can definitely change how much money you make. In lending, you get to make money twice on the same dollar. In flipping and apartment buildings like we talked about, you get to own and control all of the money and keep all of the interest you're giving away. Hey, one other thing too, I want to give you something. I got this book that I wrote, The Private Money Guide. In the description, there's going to be a link on how you can get a free copy of this. Just cover the shipping and handling or grab the ebook. So if you liked this video, then you will love this one right here. We'll see you on the next one.